Okay, let's jump right into this. If you've been glancing at the gold charts lately, you've almost certainly noticed it. Gold just printed an incredibly powerful bullish pin bar. I mean, it looks like the absolute perfect setup, right? Well, in today's explainer, we're going to completely dissect what's actually driving that move. And honestly, more importantly, we're going to map out exactly what happens next. We'll break down the massive macro forces at play, track where the institutional money is hiding, and then give you a very precise, actionable trading roadmap for the week ahead.
But hey, before we get too carried away with that buy signal, we really need to ask a pretty serious question. Is smart money actually trapping you? It's fascinating, right? You look at this obvious flashing neon buy signal, and you have to wonder, is this just a carefully laid trap? Are the big institutions simply using this to distribute their own positions before pulling the rug and triggering the next major downward move? Because the mechanics driving the market right now, they are way more complex than they seem at first glance.
So, to figure this all out, here's our game plan. First, we'll hit the macro forces, then institutional flows, third, we'll be decoding the charts, and finally, we'll wrap up with that weekly execution roadmap.
All right, part one, the macro forces. Let's look at what's actually driving the move.
Surface-level price action means absolutely nothing if you don't understand the underlying structure. And right now, there are three massive forces driving gold: US dollar dynamics, geopolitics, and institutional capital flows. The thing is, we are witnessing a genuinely rare macro alignment here. These three forces are totally converging to shape gold's next big move. So if we want to truly grasp gold's trajectory, we absolutely have to understand these drivers first.
Let's zoom in on the single biggest counterforce out there, the US dollar index, or DXY. If we look at the timeframes on the monthly chart, the DXY has basically been trapped, consolidating in this long-term bullish channel between 96 and 100 for almost 10 months now. If we get a confirmed breakout from here, wow, we're looking at a huge bullish expansion targeting 114.6 and eventually climbing all the way up to the 120 to 125 zone over the coming months. Now, stepping down to the weekly, the DXY just printed its own bullish pin bar right off that 97.6 support, forming a nice double bottom with bullish divergence. And zooming into the daily, it has completely recovered from its recent drops and is testing a massive resistance zone right between 100 and 100.2. Honestly, the probability of it breaking above this ceiling is incredibly high.
And that whole dynamic is perfectly summed up in our source material with this quote: "The dollar is the battlefield where gold reacts first and everything else follows." Seriously, keep that in mind. If the DXY breaks out of that accumulation range and rallies hard, it doesn't just bump gold a little bit, it is literally going to rewrite the entire short-term trading landscape across the board.
Okay, so the dollar is heavily driving those short-term moves, but what is providing the long-term structural support? Well, that brings us to force number two, geopolitical risks. We are seeing some significant escalations in the Middle East right now, including the U.S. deploying aircraft carrier groups and coordinating with Israel on actions involving Iran. And meanwhile, over in Eastern Europe, Russia-Ukraine peace talks have shown hints of progress, sure, but there's still absolutely no concrete agreement. And look, we're just neutrally reporting the facts here, but the reality for the markets is that until these global situations find real concrete resolutions, all of this uncertainty acts like a massive safety net holding gold prices up.
Moving right along to section 2, institutional flows. Let's follow the smart money.
So we have a super strong dollar threatening to push gold down and heavy geopolitics holding it up, but when you look past the news headlines and peek into the hidden ledger of the market, the numbers are just staggering. 48 tons. That is the jaw-dropping amount of gold that the SPDR Gold Trust has completely offloaded just this month alone. Heck, they dumped 4 tons just last week. So while all your charts were flashing these beautiful buy signals, the biggest institutional players on the planet were quietly, steadily hitting the sell button. The absolutely crucial dynamic you have to grasp here is the difference in behavior. Retail traders, they typically react to the headlines. They chase the momentum when it's frankly already too late. They see a giant rally, they get FOMO, and they jump in. Institutions, they operate totally differently. They don't predict, they distribute. They manage their risk, and they scale their exposure strategically. Right now, as we speak, institutions are quietly exiting their positions and distributing their holdings because they're anticipating that massive DXY dollar recovery we just talked about. If you're chasing the momentum right now, you might literally just be buying the bags that the institutions are dumping on you.
All right, section 3, decoding the charts. Time for a technical reality check.
Let's take all that macro data we just went through and actually apply it to the candlesticks. Let's see how these time frames piece together. On the weekly chart, we are looking at a massive clash. Yes, sure, gold printed a very strong bullish pin bar at the 4100 support level. But The recent monthly candle was overwhelmingly bearish. We're talking the highest selling volume seen during this entire bullish cycle. That's a huge red flag that the broader uptrend is starting to run out of gas. Dropping down to the daily, gold is kind of stuck in this bearish channel, making lower highs and lower lows, just grinding and consolidating between 4,300 and 4,600. But, and here's where it gets tricky, when you zoom all the way in to the H4 chart, gold has actually shifted into a short-term bullish structure. It's trading in this neat ascending channel, and it's likely to go test that 4,600 resistance. This right here is your classic multi-time frame conflict. You have short-term bullish momentum crashing head first into a brick wall of long-term bearish volume and dollar strength.
Which brings us perfectly to Section 4, the Weekly Execution Roadmap. Here is the actual plan.
Now for the real payoff. Let's walk through the 3 crucial sell zones you need to mark from March 30th to April 3rd. Zone 1 is way up at 4870 to 5000. This is a major weekly resistance round number, and historically, it boasts an over 90% price reaction probability. It's a wall. Zone 2 sits between 4670 and 4850, backed up by daily resistance. And Zone 3 is right where that short-term H4 structure meets resistance, between 4570 and 4650, carrying about an 85% reaction rate. Now, definitely notice the very strict stop losses we have in place for each of these zones. The smart play here, especially given that heavy macro backdrop we just unpacked, is to look for clear rejections at these key resistance ceilings right as that long-term selling volume starts to take over.
Okay, but what if gold just drops? Well, here are the 3 buy zones you need to watch. Zone 1 is at 4,300 to 4,353, and that's entirely based on H4 support. Zone 2 is further down at 4,100 to 4,153. That's actually where we saw that massive bullish pin bar previously. But listen closely. The absolute most critical area to keep on your radar is Zone 3. This is the deep discount zone, stretching from 3,900 up to about 4,053. If gold drops all the way down to this weekly support level, it sets up a prime, high-probability opportunity to form a massive double bottom structure for a major bullish continuation. Just be warned, if 3,900 breaks, all bets are off, and we could see a vicious slide all the way down to 3,500.
As you're navigating these zones this week, please keep this pro tip in mind. Markets are highly volatile, and false breakouts happen all the time. Actually, they're often specifically designed to trigger retail stop losses. So when a level breaks, just be patient. Waiting for the retest lets the market actually prove its direction to you before you step back in for those clean profits. And remember, the stop losses on any roadmap are really just references. You always need to adjust them based on your own personal risk tolerance and capital management rules. Probabilities never guarantee outcomes, but they absolutely keep you disciplined.
Which leads us perfectly to this final thought. Trade with structure, trade with discipline. Master gold, master the market. Look, gold doesn't just move randomly. It goes exactly where liquidity, macro pressure, and institutional capital tell it to go. We've just mapped out exactly where all those forces are pointing right now. But it really makes you step back and wonder, as you open your charts for the trading week, are you acting with true calculated discipline? Or are you just blindly following the momentum right into the smart money's trap? Think about it. Thanks for joining me on this explainer. Keep those charts clean, manage your risk, and I'll see you next time.